I'm not a professional investment advisor. The opinions expressed in this video are just one crab's opinion and should be taken as entertainment only, but I am here happy to share some strategies with you here today. Colby the DGI Crab here. Did we see a dead cat bounce this week, or are we in for the markets recovering back to where they were before the drops last Friday? Well, several things were covered. Some other things are kind of wavering around throughout the week, but for the most part, it's just kind of the same old story here for us DGI investors here. If you look at our charts, you're going to see a lot of things that look pretty familiar from last week to this week. So the broken record is going to continue on, but I don't have any problem with it. See, I think that there's some folks out there that don't like to make purchased videos. They don't like to, go over what they're buying week to week or what they like week to week, because a lot of the times with dividend stocks, it's going to be the same thing for a couple of months at a time. Sometimes you just got to jump in and buy things when they are on sale and stay away from things when they're overpriced. It's really as simple as that. That's what the strategy is, you guys. So I'm going to open up the tiers here on the spreadsheet. So for anyone who is new to this, we're looking at this valuation column here. Anything that's in the green indicates that we have something that is yielding at least 30% higher today than the 4-year average. If it's yellow, it's going to be somewhere between 20 to 29% above the 4-year, and anything red it's either 20% over or all the way down into overvalued, where you've still got stuff like Broadcom down here that's 45% higher than the 4-year average, current day yield to 4-year average. So still staying away from that, waiting for the market to correct out on that a little bit. Nike still down here, just continuing to suffer and toil away down here in the mid 70s. The 4-year average yield, I update this every week. Every week I go through here and update all of these, and this 4-year average since Nike crashed down here into the $74-$75 range was 1.02. Now it's 1.05. So a month plus of Nike being down here at 7-8 year lows has only pulled the 4-year average up by a few basis points. So it still looks like a fine value to me. And it's the only thing here in the tier 1 group of stocks, which are designed for the 18 to 30-year-old investor. It's the only thing here still that looks like an outright, flat-out deal. Nordson's kind of going back down a little bit. The share price jumped up into the 240s over the last week or so. And we're still looking for it to get down below 230 before it looks like a great deal, but Nordson's kind of standing alone here in second place on that. Nothing else has even hit that 20% mark, although I will say that when Visa gets to that 20% mark, that's a good time, in my opinion, to go ahead and add that one. Visa is one of my top 10 favorite stocks. Moving on to tier 2, age 31 to 41-year-old investors. We got a new one here on the top of the list here. Target has taken the lead over Starbucks and Hershey, but it's still these three. These are the 3 stocks that remain in the buy zone for this particular group. I don't see any reason to jump down here further and add American States Water or McCormick. We were adding those a few weeks ago when they were cheaper. Now we're just kind of in a holding pattern, waiting on those to dip a little bit. But everything else here, we're just kind of in a holding pattern on. We did get a dividend increase out of Illinois Toolworks. It went from $5.60 to $6 a share over this past week, which is a little better than 7% of an increase. Exactly what we want and expect. You see these group of stocks right here. We're expecting to get a yield of at least 2.5% on most of these if we're getting a good deal on them. And we're also expecting annual dividend increases in the high single digits. So that's why this is more of a 31 to 41-year-old group, whereas in that tier 1, the starting yields that we're getting usually are going to be in the mid 1s. Unless we're buying Nike at ridiculous prices, then we're getting it at 2. And we're hoping that our growth rate's going to be well above 10%, more like 12% cumulatively on anything that we're buying here. So compounders, not quite as strong a compounders here, but still compounders with slightly higher starting yield. And then when we move into tier 3 for the age 42 to 53-year-old investors, usually we're looking at stuff that's going to be yielding us in the mid 3s when we buy it, and we're still getting 5-6% annual dividend increases on these as well. These are just going to be a little bit slower, a little bit more stable, a little safer for the most part. Hormel Foods, Archer Daniels Midland, just like last week, these are the two that are in the buy zone and very comfortably in the buy zone for me. Medtronic and T. Rowe Price are just kind of knocking on the door. I'd probably hold off on adding either of these until they drop a little bit more, because Hormel and Archer Daniels Midland are such solid values overall. And everything else looks like we're still just kind of holding and waiting. Tier 4, the higher yield stuff for the 54 and up investor. So for single stocks, if you're in this age range, I really think you ought to probably be looking more towards higher yielding ETFs, so you get a lot of safety and diversification, and not mess around with single stocks unless, again, you're getting a really good deal. Not any screamingly great good deals on this list of 10 stocks. Verizon and Realty Income are okay at 10 to 13% off, quote unquote, but I don't think I'd be in a big hurry to add any of these. If I was in that 54 and up group, I'd be waiting for a deal. I don't see a deal here. Quick swing by. This is the tab I have set aside for my 10 favorite stocks on the market. I am down to add these anytime this valuation hits 20% undervalued, like I said a moment ago with Visa. Very happy to do so with any of these. J&J, Pepsi, and McDonald's have all flirted with 20% or top 20% over the last 6 weeks or so, but they're not there right now, so we're just kind of sitting back and waiting. And I would probably even go as far as to say, like with Microsoft, if I could get the 4-year average yield to just be equal to the current day yield, I would probably add Microsoft right at that point. That's about as good of a deal as I need on it. But, everything else looks like we're just kind of sitting here and waiting for something else. All right, so kind of the strategy and the breakdown for the week here for the tier 1. So I always recommend that if you are investing in dividend growth stocks, you put at least half your money into ETFs, so you have automatic diversification. You're not necessarily worried about adding too much of a particular sector in your single stocks. You get your diversification here. For your tier 1, 18 to 30-year-olds, I usually go a quarter or 25%, a quarter of the money into S&P 500, 15% into a small cap, 5% into a dividend appreciation fund, 5% into international. Nike, and I would actually be okay to swing up and grab a little bit of Target. I'd probably go 40% into Nike again and just continue to hammer that position hard, build up a really big, strong position before it recovers, and then hey, Target, I think you could swing up here and grab it. It is close enough at this point to being at that 50% undervalued mark that I look for, that I think it would probably be okay to go up and grab that. Maybe even Starbucks too, for that matter. But I think Target for sure. It's averaging well over a full percent higher right now than it typically has over the 4-year average. 55 consecutive years of increasing their dividend. They are a dividend king. Fantastic company. Going through some hard times. We buy deals when we find them, and I think this is probably one of them. Tier 2, we usually are looking at 25% into a dividend appreciation, 15% into the S&P 500, 5% small cap, 5% international. This is my H tier. This is what I did this week. I put 20% of my investable income for the week into Target and 10% each into Starbucks, Hershey, and Nike. Tier 3, our ETFs tend to get a little bit more dividend focused, so any combination of VYM, SEHD, DHS I think is totally appropriate here. This is kind of how I break them down, what I think is a good allocation into these. And then VYMI, keep it consistent with that 5% going into international funds. And then, this week, 20% each into Hormel and Archer Daniels Midland, the two in the green there on the tier 3. And I don't have any issue with the 42 to 53-year-old group dipping down and grabbing target. You're getting a 3.3% yield. I mean, that's kind of what we want out of this age range anyway. We're getting good, solid growth on it most years. Really like where it's at. Skip on down there and get you some target. And then in the tier 4, so this is your first time here, regular viewers that I have accumulated up to this point do know that I break out my my ETFs for the 54 plus into a bunch of different categories to make sure they're getting exposure to things that are not just simply common stocks or common stock ETFs. You've got DHS and SPYD to handle the stock aspect of it, these two ETFs. And then you have high yield bonds, SPHY. You have preferred share ETF, PFFA. MLP exposure here with the MLPX ETF. Covered call exposure with what I think are the two best covered call ETFs still, Devo and JEPI. And still 5% into the international fund. And for me, if I'm in the 54 and up, I'd probably throw just a little 5%er at target. Why not? The yield's lower than you probably want at this age, but still not a bad idea to add some things that are going to grow a little bit. And then, honestly, this week, because there's just not anything in that group of 10 stocks for the 54 plus that look enticing to me from a price standpoint, I'd probably just double down and just 2x the allocation on all of the ETFs except for VYMI. I'm still going to keep that international at 5%, but I'd probably be doing 20, 20, 10, 10, 10, 10, 10, 5 into target. That seems like a pretty sensible idea to me, and we'll just wait to get good deals on the single stocks, and then in the meantime, all of this stuff here is going to be pretty high yielding. Several of the things here are going to pay monthly, like DHS, SPHY, PFF, Devo, JEPI. So really, really ideal for people that are in that age range looking for immediate income right now. So that's the breakdown for this week, y'all. I'm traveling. Hopefully the sound quality on this one wasn't too bad, but I did want to at least get this one out to you. If I play it back and the sound is terrible, I'll record another one of these tomorrow, but I wanted to get this information to you here today. All right, everyone, until next time, this is Colby the DGI Crab. Links in the video description below to each of the 4 tiers, where I will break down for you why I picked each of the stocks that this channel covers, 60 in total. And also you can email me any questions you may have about this at dgicrab@yahoo.com. Have a great weekend, everybody. I will see you next time.